Hey traders, there's been so much talk on the interwebs, the social media platforms, Twitter, Reddit, and YouTube about zero DTE SPX trading, essentially just day trading the SPX Monday, Wednesdays, and Fridays when they have options that expire on the very same day. But there's another way to approach that same thought process, and we call it 4 DTEs. 4-day to expiration trades. Could it be a better approach? Could it be a approach that more appropriately aligns with your risk reward profile, your trading propensities? I don't know. Let's take a look at it. All right, so let's get into this topic, this conversation of trading 4 DTE expirations versus 0 DTE expiration, and why I think it may, if nothing else, be something that is appropriate for you to look at, contrast, and compare with your 0 DTE trading. And it may or may not be a better fit, or as I have found in my trading and a lot of people in our live trading room have found, it doesn't necessarily need to be an either or scenario. It can be a nice complement to our 0 DTE trades. So let's get into talk about it. If you guys are not aware, my name is Scott Stewart and I am a full-time trader. Been trading for a long time. I started as a stockbroker in 1987. This is all I've really ever known as trading. And we used to do 0 DTE trading, which of course, if you're not familiar with, 0 DTE is just a shortened way of saying a day trade. 0 days to expiration trading. And we used to do 0 DTE trades every single month back in the days, back in the 80s. But of course, we only had monthly options. And so you had to wait until the third Friday of each month to get your 1 0 DTE in per month. And then we had weekly options, and that was great. And now, of course, on the SPX, as well as other indices and underlines as well, we have options that expire thrice weekly, Monday, Wednesday, and Friday. And so day trading those indices, and primarily the SPX, although we do in our trading room, our live trading room, trade other ones as well, has become a very, very interesting trade, and it's become a very popular trade. But it may not necessarily be the best trade for you, just depending on your situation. And so I wanted to talk about a 4 DTE trade that we have had a lot of success with, and maybe how that might incorporate into your trading, and look at some of the pros and cons between it and the 0 DTE trading. So we do have a live trading room that we have about 200 or so members in there that we get together every single day and trade different things at different times, but it was really centered around this idea of 0 DTE tradings. Every Monday, Wednesdays, and Fridays, we get in there with a live Zoom feed and a live chat room, and we focus on these 0 DTEs. But in December 7th of last year, so December 7th of 2020, we started to do 4 DTE trades. And these trades were not on the SPX as we do with the 0 DTE right there, but we started using the SPY. So it was the SPY that we started doing 4-day to expiration trades on. And we would initiate these every Monday, and then either book if we got a decent capture rate on them at some point in the week, we would book those profits, or we would hopefully carry it to fruition to a Friday expiration, hence the 4 DTE moniker. And the original thought process behind doing these 4 DTE trades was really just twofold. Number one, if you are trading a day trade strategy of any kind, it could be 0 DTE on the SPX, or it could just be day trading Tesla for all that matters. You are most likely going to run into PDT issues. And PDT issues can be troublesome if you are day trading enough to where you trigger those, and you would trigger those if you were trading less than $25,000 of equity. And so we had a lot of individuals that would contact me either via Twitter or were already in our live trading room that wanted to do the 0 DTE trades, but they were concerned about getting pattern day trading violations, getting their accounts locked up, being subject to close-only orders, all of that bad stuff. Getting put in PDT jail is not fun. And so one of our ideas initially was, hey, if you don't have $25,000 to trade this particular strategy, we could instead maybe go out 4 days to expiration. That would avoid the PDT issues. We would not be getting in and out of the same position on the same day. It wouldn't be triggering a day trade, right? So if you are, as we like to say in our trading room, capital constrained, if you're capital constrained, you could still trade this strategy. So that was one of the ideas about going out to a 4-day to expiration. And then using the SPY, the main reason behind that as well was because the SPY, of course, is 1/10 the nominal size of the SPX. And so, again, if you are capital constrained, it is much easier to trade the SPY than it is the SPX. Now, there are some differences in taxation on each of those. I don't want to get into that because that's not really anything that I even pay attention to as a trader. The taxes are going to be what the taxes are going to be. And let's first of all focus on building profitable strategies and worry about taxes much later. But nevertheless, we started with this. And again, that was the original thought process behind this is go to the SPY, which is 1/10 the size of the SPX. That would be a little bit easier if you had a smaller capital amount to work with. Go out 4 days instead of 1 day. And that would allow us to avoid PDT issues, pattern day trading violations. We wouldn't have day trades in the trade. And then what happened as time went by, we really saw, so again, really it was just done out of necessity for members in our trading room that wanted to go trade a similar strategy to the 0 DT, but just simply didn't have the ability to do it. And so that was the thought process behind that. But as we started this, the trade really evolved over time. And the evolution of the trade has really started where we are now every single week in our 4 DTE strategy. We're trading 2 indices. We trade the NASDAQ or the Qs, and we also trade the SPY as well. And we trade them simultaneously. So if you are going to do this strategy, our results have shown that it is best to do both indices simultaneously. And one of the reasons for that we have found is, you would think, well, my goodness, these indices, does it even really matter what index you're trading? Because they all really kind of move and ebb and flow in the same manner. And that's pretty much true over a longer period of time, a 6-month to 12-month period of time. Most indices do sort of move in lockstep, but on a week in and week out basis, and especially on a day in and day out basis, that is absolutely not true. We have found some huge divergences between the major indices, between the NASDAQ or the Qs and the S&P 500 or the SPYs. And you can see, if you take a look at this, that there really is quite a different structure to these indices, and with the cap weighting being what it is now, to where in all of these major indices you have about 6 companies that really control the destiny of each one of these. We have found a tremendous amount of diversification by trading both of them. So one of the things that we have noticed about these trades in comparison to our 0 DTs, and again for me individually, I have made the decision that I continue to do my 0 DTE trades every Monday, Wednesday, and Friday, but I am also initiating this process of implementing 4 DTE trades And we usually establish them on a Monday. Sometimes we will wait until a Tuesday to establish these. And one of the nice things that we have found about initiating these 4 DTE trades is that if the market doesn't necessarily give us the technical signals that we desire, or the premium for whatever reason just is not there on a Monday, and we initiate these trades on a Tuesday, we don't really lose a lot of the potential of these trades. They are very, very flexible versus, as you know, with a 0 DTE, sometimes even though you have a 6.5 hour or so trading window every day on these 0 DTE opportunities, there can be a half hour to 1 hour window during that time frame where it is optimal to get into a 0 DTE. And if you miss that window, you've kind of missed your trading opportunity for the day. So one of the things that we do that we really love is the flexibility of these 4 DTEs. We usually scale into those trades, meaning that on Monday morning when we get our first positions started on them, we don't usually do a full iron condor. We will trade the strong side of the trade, meaning we will scale or leg into the trade. We will start on one leg on Monday, and then on Tuesday, or even sometimes as late as Wednesday into the week, we will put the other corresponding leg in. That usually gives us a little bit better control over the trade, and sometimes we will actually start the trade off where we are maybe starting on the put leg with the SPY and starting on the call leg with the Qs. And it gives us the ability, again, to sort of play one trade off of another, sort of hedge our bets, if you will. So it's been a really awesome strategy from that standpoint. From a risk-reward ratio standpoint, you kind of know the numbers if you've traded 0 DTEs enough at this point in the game. With a 0 DTE strategy, with the deltas that we usually use, is generally around a 16 delta is where we typically start at. It could be as low as a 7 or a 9 delta. It can be as high as a 23 to 26 delta in some cases, but generally with the 16 delta where we start with, and then where we usually are legging into the trade. We're not putting on a full iron condor, although we do sometimes. But regardless, that's generally the way that we do our 0 DTE. A perfect day would be a double-digit return. That's what we look for, is in a perfect case scenario, we get a double-digit return, meaning about 10% return on your capital for the day. Now, what do we mean by a perfect day? It means that we get both legs of the trade in. We get a put side spread and a call side spread in. And it means that you take those legs all the way to expiration. You don't have to adjust them. You're not booking a 60, 70% capture rate. So as you can imagine, it's not always easy to get a perfect day. But if you do, that's what our goal is, about 10% ROI on the day. And the challenge, of course, with the 0 DTE is that they have, and really there's no other way to put it, they have a really, really wicked risk-reward ratio. In those trades, typically you are risking around 70% of your capital, your committed capital to the trade, if the trade were to go max loss on you. And what we mean by max loss is that it goes through both of your legs. It goes through your short and your long leg on your spread, and that's where you end up at the end of the day. So, you know, you could put up $10,000 on a 0 DTE, and if the day was a perfect success, you could bring in $1,000. That's really enticing. A lot of people are excited about putting up 10 grand and potentially making $3,000 a week of income off of it, but they sometimes forget that risk side of the risk reward ratio, which is that 10 grand that you're putting up, you're risking about 7 grand of it if that trade were to go against you, which means that you could literally need to book a 7 wins in a row just to get back to break even. So the 0 DTE trades are awesome. If somebody was to ask me what is the quickest, fastest way to make the most money possible, well, day trading is probably it. But I don't think anybody out there that I have seen gives enough credence to the amount of risk that you take when you do that. And 0 DTE trades, guys, no matter how you slice it, they're risky. They are risky trades. Now, our 4 DTE, let's talk about some of the numbers that we have seen on this. We did start initiating our 4 DTE trades December 7th of 2020. So far, so we're just literally just at the 1-year anniversary of doing these. We've done about 54 of these over the last year. Well, not about, we've done exactly 54 of these trades. 50 of them have been winners, 4 of them have been losers. So about a 93% success rate on those. That compares quite favorably to about an 84% success rate with our 0 DTEs. So as you can imagine, most trades, not these trades by and of themselves, almost any trade is going to be a little bit more flexible, a little bit easier to manage. The further out in time you go, the more you compress the time, the more challenging it can be to manage those trades if they get into a bad position. So about a 93% success rate on those 0 DTE, or excuse me, on the 4 DTEs. And what we have found typically is that when we were able to put them on a Monday, it hasn't affected the results too much if we put them on a Tuesday, but if we put them on a Monday and it goes perfectly according to plan, we have the potential to make about 10% ROI in a week. Now, 0 DTs can make 10% in a day. 4 DTs can make 10% in a week, right? But we've talked about the risk side of this. The risk of a 0 DTE is about 70% of your capital, whereas what we have found drawdown-wise, the risk on a 4 DTE is about 20 to 27% of your capital. So it is a little bit better on the risk side of the equation. Obviously not as much profit potential, but there's a risk-reward trade-off on every trade that you do. It is a little bit more adjustable. So one of the things that we have found is that generally speaking, and you know, there's always an exception to the rule, but generally speaking, we do not adjust a trade if it doesn't meet our criteria for adjustments. Now that's kind of our claim to fame in our trading room, is that we don't use hard, set, fast stop losses. We actually use a mental point in a trade where we say, okay, we're down 2 times our credit, 3 times our credit. Each trade is a little different, but at that point, we don't take a loss. We will roll and adjust the trade. We only start with 1/3 of our capital so that we have 2/3 more capital to commit to the trade. We adjust, we maneuver, and there's a video on our YouTube channel here talking about the 6 or so different adjustment methods that we use. If you just search on my YouTube channel adjustments, you'll see that video. But we adjust those trades. Now, generally speaking, a 0 DTE is not going to be a trade that is rollable. They are adjustable. We adjust them pretty much 70% of the time. I'm looking right now at making a video review of the week of the 24th of November. The week of 24th of November was interesting because we had a Monday 0 DTE, we had a Tuesday end of month 0 DTE, we had a Wednesday, and we had a Friday. So we had a whole bunch of shots at this. On Monday, we did 1, 2, 3 0 DTEs in the day. On Tuesday, we did 2. On Wednesday, we did 2. And on Friday, we did 2. So we got a whole bunch of 0 DTEs in on that week. Every single one of them was profitable. Every single one of them needed to be adjusted. Every single one of them. Meaning if we would have just thrown them on and left them, they would have ended up in the loss zone. So they are adjustable, and we do adjust our 0 DTs quite frequently, but they are not rollable. Now, that being said, we have rolled just a few, just a handful. In the years that we have done this, we have only rolled a handful of our 0 DTE trades. For whatever reason, I don't know exactly why, but every single one of them has been a 0 DTE on the Russell, on the RUT. And they just simply met our criteria that we could roll it out and gain time. We have a threefold criteria that we look at. We want to be able to roll it out, gain more time, obviously. We want to be able to roll it away from the strike price so that it gains more probability of success in the trade. It makes the trade safer, and we would like to do it at a credit. We call that the trifecta on a roll, and that's generally almost impossible on a 0 DTE. So we have only had in the last year maybe 3 0 DTEs that have been rollable. They're just not a rollable trade. And sometimes You just, people say, well, man, you're only 84% success rate on your zero DTEs. What happens with the other 16%? You take a loss. You end up in the red at the end of the day, and you dust yourself off and you pick yourself up and you go about doing it again in a couple of days. But they're not rollable, generally speaking. Our 40 TEs we have found are very rollable, very, very rollable. And that is I believe, primary reason why we've been able to have a 93% success rate with those versus an 84% with our zero DTEs. They're just a little bit more adjustable. And then last but not least is the passive nature of these. And so one of the things that has been a challenge for us in our live trading room is that there are just not as many people anymore that are able to sit around and stare at their computer screens for 6.5 hours a day every Monday, Wednesday, and Friday. The pandemic is, I don't know that it's getting any better, but people are just getting sick of it. And they're going back to normal lives. People are going back to their normal routines, and people are going back to their offices, and lives are sort of returning to normal. And we just don't have this group of people that either has the ability to, or in some cases may have the ability to sit in front of their computer 3 days a week, but doesn't have the desire. We have a lot of people that are working from home or in front of a computer doing something all day long that could very easily trade the zero DTE strategies. They just simply have no interest in it. It doesn't excite them. It is nail biting, and they don't like it. And so from a passive nature standpoint, the 4 DTEs are quite nice, because if you have a lifestyle or it's simply a desire to not be in front of the computer all day long, everyday day trading, a 4 DTE can be much more passive in nature. So that's sort of the pros and the cons. That's the ups and the downs of maybe the differences between our 4 DTE strategy and our 0 DTE. As I have always said, I think that it is prudent to diversify yourself. And one of the things that we diversify through is not just the volume or number of trades that you have on at any one time, but the diversification of strategies. And we have found that there is quite a big divergence between the results that you get from a 4 DTE versus the results that you get on a 0 DTE from both a risk and a reward standpoint. So I do them all. I do the Qs and the SPYs every week, as well as the 0 DTE. But if you have not taken a look at a 4 DTE trade, I would recommend that you at least do a little paper trading on that. Check them out. I think that you might find that it might bring some upside to your trading life. Something that's a little bit more passive, a little easier to adjust, something that's not as nail biting, and something that enhances the other trades that you're doing. If you ever want to, if you're not in our live trading room right now and you'd like to come check it out and watch us do our trades individually. Again, I can't give you investment advice. I'm not a licensed investment advisor, but you can get a live data feed to watch me trade my own personal account, and we can always chat about trading inside of our live trading room. We do have a 1 week free trial that you can jump on and check it out. Throw a link in the description box below. But hopefully this has helped you guys that are interested in the 4 DTE strategy get a little bit more information on it. Good luck to your trading, guys. We'll talk to you soon.